Let's take a deeper dive. We'll get to Alex in a moment here, but let's get to our reporters to take a look at what they were watching at the close. Emma, get us started.
Of course, you had to be watching the S&P 500. As you said, they're closing at an all-time high, crossing that key level of 2,945. And it looks like the rally was pretty broad-based. Around 20% of S&P 500 stocks hit 52-week highs. That makes it one of the broadest surges forward since the beginning of 2019. This G chart is showing you the performance of all three majors on a monthly basis. You can see at the end there, we're looking at June. Barring any major reversal tomorrow, we're looking at three very solid and strong weeks for the S&P 500, the Nasdaq, and of course the Dow Jones. If you compare that with obviously what we saw in May, we're almost looking at a mirror image of what we saw in May, and it seems that the market nightmare that was May was perhaps a blip for this year, and very much behind it for investors. Abigail.
Emma, let's move from stocks to bonds and check back in on a chart we've looked at a lot, and a chart that is hanging on by a thread. It's going to be very interesting to see what happens here. Of course, it's the 10-year yield over the last year. We see for much of 2018 hanging out around 3%, even higher than 3%. But then we had the risk-off volatility of the fourth quarter, and we see investors seeking safety, moving into bonds, moving all the way into the lows here of less than 2% earlier, but right now clinging to 2%, the bottom of that trend channel. And you can see in past times when support has been hit there, we've seen a backup in rates. In this case, we could see the 10-year yield back up to about 2.35% or higher. However, Mike, also in the background helping out this move lower, death cross that we've looked at often, it is confirmed for even deeper below 2%. But right now, Mike, it does look like there's a chance we could see a backup in rates, especially with that momentum indicator looking to come back up. But again, hanging on by a thread, Mike.
All right. Well, thanks, Abigail. Well, one of the groups not participating in this rally to a record for the S&P 500 today are cruise ship companies, led by Carnival Corp, especially, down about 8% at the close. It was down as much as 13%, which was its biggest drop in more than 7 years. And Royal Caribbean and Norwegian Cruise Lines are also among the biggest decliners in the S&P 500. Now, higher energy prices, just like with airlines, is part of the story. But really the big issue is that Carnival cut its full-year earnings forecast for the second time in 3 months. And there's a few reasons why. One is the U.S. crackdown on travel to Cuba is hurting its cruises to Cuba. And also, it had to cancel some cruises from its Carnival Vista ship because of technical problems. But overall, it's just not a good time for cruise line operators. This according to Carnival CEO Arnold Donald. He said in today's earnings release that recent booking trends have become impacted by ongoing geopolitical and macroeconomic headwinds. So, Scarlett, something to keep an eye on as far as what's getting impacted by this global softness in the economy.